editor of Cycles Magazine, Bill Sarubbi. Bill, thanks for joining us.
Thank you. Good morning, everyone.
Good morning. So, Bill, you have been involved in the world of cycles for a while now.
Yes.
Why don't you give everybody just a brief background on your history and interest in cycles?
Oh, sure. I got interested in the stock market when I was about 16, 17. I became interested in cycles of history. Then when I got my MBA from NYU, and I got out just in time to see everything that I was taught didn't work too well when it came to forecasting. So I joined the foundation, and I read articles by Ed Dewey. And I was particularly interested in cycles in the stock market, 18 years, 9 years. And at that time, I was living in the center of, I lived only a couple blocks from George Lindsay, who wrote from 53 to 85 or 6 till the time he died, a weekly letter for Ernst & Company on Wall Street. We had a group called the Society for the Investigation of Recurring Events, SIRE, which was an offshoot of the foundation right there in New York. And it was sort of cycles heaven, you know, if you liked technical analysis, trading, and so the minute I got out of school, I started to apply cycles and was an analyst on Wall Street and then a fund manager. And you know, I think we're in it's very apt that the foundation comes back online now, because with the tools we have, with the PCs and the software, we can do things now that the early cycles pioneers simply couldn't do. So it's a very exciting time.
Absolutely. Can you turn your volume up a little bit on your microphone, Bill? Is that possible?
How is that?
That's better. Very good.
Okay.
That's good. Okay. Great. And you have pretty extensive experience managing money. You do this, you know, this isn't just academic for you, let's say.
No, I've actually applied this stuff. In the presentation I did at the foundation, the meeting we had last June. Mm-hmm. Yeah, those were real-world examples. I actually used those. I was with Abu Dhabi Investment Authority for 13 or 14 years. Now, I ran their technology fund during the 90s. And you know, I worked at the New York City pace. And in Abu Dhabi, it takes about 2 hours to watch 60 minutes. In other words, the pace is slow. So I had plenty of spare time to do a lot of cycles work. And I'll give you an example. We're just finishing out, I'm going to point this out in my presentation. There usually is, if you take the average movement in the market month by month, there is usually a top around the end of the first week of, from about December 7th to 15. The single weakest group for many years was the SOX, the semiconductor group, and I was managing the technology portfolio. So that was something, you know, there were these technology usually tops around August 15th and bottoms around October 15th if you average all the years out. So in other words, it tops about 2 weeks before the regular market and bottoms about 2 weeks before the regular market. And I would do things like trade out of the big stocks, Cisco, Intel, Microsoft, where we were heavily overweighted, and I would, for those 60 days, I would trade out into stocks that were in the technology sector, namely information processing, like automatic data processing, paychecks. And it turns out that seasonally, the best time to own those stocks is August, September, October. And I would shift out for the 3 months, and as the big name tech stocks came down, these stocks went up. And I would add basis points to the portfolio that way.
I remember talking during the Cycle Summit back in June, and the way I summed up your work was, it's offensively simple.
Yeah, it's too simple for most people, yes.
All right. Well, Bill is also a writer for regular contributor to Forbes magazine and also a member of the Kinos Circle, which is, how would you describe the Kinos Circle?
Hasn't met in a long time. It's a group of futurists. When I moved to Vienna, Austria, I came in touch with Dr. John Casti, who's written about 16 books in mathematics, and well, you know him, Richard. He's involved with all the think tanks. He was actually working for the Rand Corporation when he got his PhD. And John and I meet regularly in the coffee houses, and he got a group of futurists together, and they haven't made any predictions, but they had a few conferences, and they haven't been functioning for a while, but we still go to the coffee houses and meet, and I love to talk futurism.
Great. All right, well, let's take a look at what's happening in the markets today.
Okay, well, page 2. Summaries, the second half of December is likely to be strong. that's where we're at. And it's very easy to put up cycles on the screen. You'll get something. To confirm them and actually use them, it takes a little work. Like if the sell in May period is strong, as the 2020 period was, the odds for a strong market into May is high. In other words, typically the market, the annualized return, the return from October to May is about 8%. From May to October, it averages out to 0. If that May to October period is strong, the odds of a higher market from October up until May are increased. That's what I mean when I say confirming the cycle.
So strength begets strength.
Yep. If I put it this way, I remember I was in London with Robin Griffiths and the London gang of market analysts, and I said, I don't think cycles are ever wrong. If there's an old saying on Wall Street, if you have a very high probability buy or sell and it doesn't work out, then double up your position in the opposite direction. And what that means is there's some cycle that is stronger than the ones you're looking at. And so the cycle is there. And I always like to joke, how do we know that the Pharaoh didn't get wiped out of all his wheat positions 3,000 years ago by some huge cycle that only occurs every 3,000 years? We don't have enough data to really know that. So I don't think cycles are ever wrong. There are just big cycles that exceed history.
It's just interesting, though, because most people would think, hey, if it was up strongly from May to October, then the gains are gone and it's not going to be up. But you find that if it's up strongly May to October, October to May is going to be even stronger.
That's correct.
Okay, great.
And the cycle indications, as we'll see, the next significant high will be in April, May. Now, just to give you some idea, in December, my data starts in 1885. I started in the days when we did everything by hand in a yellow pad, then moved up to Lotus Notes, Lotus spreadsheet. From 1885 to the present, in all Decembers, 68.3% have been up. So there's an old saying on Wall Street, if you can be correct 60% of the time, you can make a fortune. Well, we're at 68.3. In Decembers, in years ending in 0, it's 69.2. In election years, it's 62.1. In both 0 and election years, it's 66.7. So you can at least comfortably say the odds are 2 out of 3 that the market will be higher on December 31st than it was on November 30th. And this month has the highest percentage return, 1.3% per month. It is the least volatile month. October is the most. And in the last 20 election years, December was up in 16 of them. So this is the type of thing. These, Richard, are what I call static cycles, in that they don't change that much. To change this, you might need 20 or 50 years more data. So yes, they change, but not that much. Not that we have to be very concerned.
Bill, do you have a timer going in your background, or is that me?
Yeah, hold on just a minute. I'm sorry about that. I've got to move. Very sorry about that. Okay.
No worries.
The market tends to sell off from the 8th to the 19th. I mentioned that to you. It's up only 49% of the time since 1885.
Of December. Now, is that what we're talking about here? December?
December in the Dow.
Right. So you really study these, you study weeks and months, specific weeks and months of the year very intensely. It's a big part of your work.
Yes. And from the 8th to the 15th is the worst week of the year for the NASDAQ. Now here, if it doesn't work out, most people who don't value cycles would sort of laugh and walk away.
Right.
Well, if it's not down significantly from the 8th to the 15th, my software will tell me, what the effect is if it's up from the 8th to the 15th. And the effect is especially pronounced in the SOX, the semiconductor index.
Interesting.
The SOX index has risen only 20%, 28% of the time over the last 25 years from the 6th to the 15th of December. Well, right now we're at the 12th, and we will be at the 15th early in the coming week.
So it's literally those dates. It's not like the second week of December. It's the 8th to the 15th is the worst week of the year for the NASDAQ.
Yes, it is.
Okay.
And you have
All right.
to realize
Great.
you're taking averages.
Yeah.
So it could be half of the time it could be on the 6th, half of the time it could be on the 12th, and it will average out. That's how it works.
It's interesting that it's
So-
sort of lined up with the Facebook antitrust case this week. Facebook got sued,
Yeah,
and
it's about time, yeah.
by the 48 states, I think, and the FTC. So yeah, interesting timing.
Well, that's the type of fundamentals I was, when I was in school, the case they always used was if you owned IBM, and I was in school in the 60s into the early 70s, what was the problem IBM ran into? And it was the government. And that's a problem you don't want to run into, because the government is always bigger than you are. So,
Yep.
and now also, if there's an all-time high in November, the next month is up almost 80% of the time. So the odds for a higher December were between 66 to 80%, the way I'm looking at it. And you get a low right around this time. So in my Forbes column, which we'll publish noontime tomorrow, Sunday, I have pointed all this out. And in my work that goes out to the institutions or individual traders, I've pointed this out. And last week, I think the S&P lost about 30 points.
Mm-hmm.
And I stated that I thought the market would be weak, but I didn't think it would be weak enough to go short.
Mm-hmm.
Because it would be very volatile. So I've just held on my positions and added on Friday at the close. That's how I actually handled it.
Mm-hmm.
Now, knowing how far it's going to fall, it comes from the realm of technical analysis, not cycles. And this is my S&P monthly cycle.
Okay.
And as you can see, the green line, it's just given a buy. And when did it give it? Around December 3rd or 4th, which coincides with the onset of the week period. And you'll note the S&P did come down, but it came down only in about 2 days. So that's not easily shortable. In other words, this cycle was pointing up when the period, the 7th to the 15th, was pointing down. So the result you got was a very mild decline. I'm not going to try to short that. That's too risky. That's playing with fire.
So, Bill, this is essentially a seasonal chart here, an average performance? No, this is a different cycle.
This is a dynamic cycle. This is extracting the current cycles from the market, eliminating the ones that don't work well, and only adding together the ones that are the strongest.
Okay.
And that's the result.
And how far back, what was your look back period for, finding those cycles? How far back does this go? Is it 10 years, 20 years, 50 years, 100 years?
The data on the S&P starts in 1980.
Okay.
And the last year is out of sample. And the rest of the time is in sample, which I can easily change.
Okay, got it.
And so, according to that, this has given, I think, 4 buy signals in the last year, or 2 buy signals and 2 sells, and all of them have been accurate. That's to be expected with a monthly cycle.
Okay.
If you go to the weekly cycle, in September, the weekly cycle on sells was only accurate 1 in 6 times. Right now, it's 1 out of 2. So the weekly cycle right now is pointing down. But this is stronger than that, and the seasonality is stronger than that. So when you get into this, you can get overwhelmed with cycles, and pretty soon you begin to learn that the dynamic cycles are stronger than the seasonal cycles.
Okay, great.
So now this is OPEX week in December, which is coming up. Now the red is the likelihood that the market will be up on any day. And if you go all the way to the right to Friday, it's almost 70%.
What is OPEX week for those who don't know what it is?
Option expiration week, the third Friday in every month.
Very good.
And it begins in 1985 because that's when the options began. So if you notice, it says Friday and it quotes 30. That's 35 years, 35 Fridays, and the blue bar is the percentage gain. And the green bar is the product of the red and the blue. In other words, if the market is up 1%, 50% of the time, 0.5 times 1 is 0.5%, is the expected return. So the green bars are the expected return, which is the one I pay the most attention to.
And this is in the week leading into expiration or the week after expiration?
This is the week of expiration, which is this coming week.
Got it.
OPEX week is usually strong. It's strong. It's a man-made perturbation in the the monthly prices, but it varies greatly by month. In September, it hardly works. So in September OPEX, you can forget.
Okay.
And some months are stronger than others.
Wow.
So this is another plus. You see how the evidence is building up for a move up this week.
Got it.
And now back to the world of plain vanilla technical analysis. The advanced decline line is at a new high. There's no doubt about that.
Yep.
And if you put it on a 10-day basis, now this is one of the best short-term measures anyone can use. Right now, you notice it got very oversold at the end of October, and it's rallied up, and it's staying high, yet the market is not coming down much, and there's a very good reason for that. The big cap stocks were carrying this market higher because they have the highest weight in the indices. And what began to happen, we'll get to that in a minute, but this is now we're in the world of technical analysis and setting objectives. That is a rectangle. And as any technical analyst knows, that is a formation. If you break to the downside, you break to the upside, you go with the direction it breaks out in, and the measuring formula is the height of that rectangle, which is about 300 S&P points. So this is saying that the market could go to about 3,800, 3,900 before it's finished, and the support line is that blue line at the top, which is around 3570 or 3580.
Yep.
And the Financial Analyst Journal, these guys are PhDs, like you, Richard, they wrote a fuzzy logic program, and they tested out a lot of the standard technical formations, and they said the rectangle was the single most dominant or prevalent formation that you'll see.
Wow.
And the rectangular low was the single most profitable. So in other words, if a stock is trading in a range back and forth and back, and it breaks out to the upside, that is a very reliable signal. So this is not just plain vanilla technical analysis. This has been confirmed by the Financial Analyst Journal of PhDs.
Wow.
And the biggest rectangle I ever saw was in the old days. Smith Barney used to put out industry graphs that began at the end of World War II. Talk about long term. And the food group, and I was a food analyst for the Value Line Investment Survey, and I'd go over there and hang out with the guys in the chart room. And for 25 years, the food group traded back and forth in a long triangle. And in 1980, it broke out to the upside. I didn't even know that. I got up to Smith Barney, and they said, "Hey, Bill, what is happening with the food stocks? Are people eating more food?" And I said, "Well, why do you ask?" And they said, "Well, it's broken out of this 25-year triangle." And if you remember, that group went on a tear for 13 years.
I don't remember.
13-year rally from 1980 to 1993. And when I got to Abu Dhabi Investment Authority in 90, I said, "Hey, you guys are very underweight in foods." Here's the response, and this tells you a lot. They said, "Well, the earnings growth there is only like 8 to 10% a year." So in other words, they don't look at the share price, they look at the earnings. And they said, "Well, the earnings," I said, "it's been going up, in relative and absolute terms for 10 years. And went up for 3 more years, but people they don't focus much on price. And as I always say, when you buy, you get the share price. When you sell, you get the share price. You don't get the earnings or the book value per cubic centimeter or any of those other measures." So this points up.
Right.
And now, why is the breadfly hanging up there? This is the Value Line Index, VLI, divided by the OEX. The OEX is the S&P 100, the 100 largest cap stocks. The value line is where I used to work, is 1,700 stocks equally weighted. So that's what most stocks are doing. So you see that big drop into March? What that meant was that the big cap stocks were holding up much better than the value line. And since that time, we'll look at the acceleration since September. And I advised fund managers who were saying to me, if these, what are these big cap stocks going to do? Apple, Facebook, Google, how much higher can they go? And I said, well, again, fund flows. Money will flow out of those into the smaller cap stocks, and you can see it right there from the end of September up to the present. So in other words, more stocks are rallying, but they have such a small market cap that they don't affect the indices very much.
Okay.
So that is why the breadfly 10-day advanced decline line is hanging up there, and the market is not pulling back very much. It's because there are more stocks participating. And so if we
you expect that trend to continue with small caps outperforming?
Yes. Well, the people don't understand. The Federal Reserve Bank it is a credit creating corporation that it creates credit, and it creates too much, and the excess has to go someplace.
Yep.
And so there's no shortage of funds to push the market up.
Mm-hmm.
So if we go, I think energy will be a leader. Now, the last time I was on Cycles TV, I pointed out that the XLE, which is the ETF for the energy industry, was bottoming. And I just want to say it's right back. If we look right here, that's approximately, I think, when I was on, somewhere in here. And you see the telltale, this is a weekly chart, higher lows in momentum, and the breaking of the relative strength line. This is the relative strength versus the S&P 500. And this is classic. This is higher lows in momentum and a break of a relative strength downtrend. And here you have a double low. So here you had a low, here you had a higher low. It's confirmed here and confirmed here.
Higher low in momentum.
Yes.
And that's a 5-15-3. What is that indicator?
It is a 5 periods minus 15 periods taken as a 3-period moving average. So in other words, it's a 5-week moving average minus a 15-week moving average. You take that entity as a 3-period moving average. That was developed by Ian Notley at the Notley Information Service way back in the 80s and 90s. Some people have told me 10 and 30 works better now, 10 time periods and 30. But they optimized that, and they said that works best with equities.
So it's 5-week moving average, 5-week moving average minus a 15-week moving average.
That quantity taken as a 3-period.
And then you take a 3-period moving average of that.
Yes.
Okay.
I've been using it since 1980, since I met Ian.
Yeah, looks great.
Now this will be in Forbes tomorrow at noon. It will go online. I expect it to be a rising week. I went through all the stocks, and which stock. There are different ways to look at this. This is the daily chart for Marriott, ticker symbol MAR.O. And you see the green line? It bottoms, I think, Monday or Tuesday. And it doesn't give a sell until somewhere in the second week of January. I'm only concerned about this week. So here is where an individual stock lines up with the market. Now, in the last year, 100%, I think there were about, if I remember correctly, there were about seven or eight buys and 7 or 8 sells. This is a rare stock. I call it a 100 stock. 100% of the buys and 100% of the sells in the last year have been accurate. And I have no idea why Marriott, why this industry. I'm just looking at the numbers. So I've traded this stock successfully all year long, and it's giving a buy signal right now. And this will appear, as I said, in Forbes Great Speculations, noontime Sunday. And if we look now, here we go back to plain vanilla technical analysis. You have the same. Now this is daily. So that blue line you see is 5 days minus 15 days, quantity taken as a 3-period moving average. And at the bottom, you see the relative strength versus the S&P has been quite healthy. So I'm looking for a move up, and the stock could, I think, trade up to 138, 135 to 140 in the next week or two. So now gold is a little more complex. Gold is up short term, but the cycle points down next year. I don't know how or why, but right now, let me see. Here we go. Here's the gold seasonality, and this is the same type of layout as we saw before. The red line is the probability it will be up. So if you look all the way to the right, November and December, you'll see it's up more than 50% of the time, almost close to 60. Okay. And the blue line is the percentage increase in the price, which if you look to the left scale would be about 0.5% in November, but in December it's almost 1%. So December has been a very strong month. Mm-hmm. So the seasonality is favorable, and here we have this is a weekly cycle, and you'll see it points up into the middle of the month. Now you see that. Now here's where it gets tricky. Is that a sell signal around December 17th or so? Well, let's look at this. Well, no, the seasonality is still holding it up. So even if this weekly kicks in, I would not be a seller. I think gold will be strong through the month. Mm-hmm. And here is the monthly cycle. Now, if you'll note right in here, this is December, right? So right now you have the monthly, the weekly, the seasonality all pointing up. The odds of an up market in gold are very high into the end of the month. But now let's look at this. This doesn't seem to make much sense if you are forcing tons of liquidity into the system, but the market is a discounting mechanism that looks forward.
Mm-hmm.
So at the moment, I am bullish on gold until the end of the month, but bearish after that. And I don't know what and you have to remember, it's investor preference that drives stock prices. So we were just, before we went on, talking about real estate, and I do agree that I think we're in the accelerating portion of the goal of the real estate cycle, as Phil Anderson would explain.
Mm-hmm.
And so that's where it's going. And if you've worked on Wall Street long enough, and I'm sitting at my desk at Value Line, the senior guy comes in and it says, hey, one of your stocks is up 20% in the last quarter. That was a big move in the old days, in the 70s. What's the reason for it? And I said, well, none that I know of. And he said, well, I need a headline for the masthead of the publication. And there's got to be a reason. And I was sitting there looking kind of puzzled, and another senior guy who had an office next door, he poked his head in, and he said, when in doubt, make something up. So that's the way the news works on Wall Street. If the market goes up, they go to the bin of bullish news. If the market goes down, they go to the bin of bearish news. So the joke around the office was, if the market's up, it must be a rise in the latest number of Elvis sightings and things like that. We were always inventing peculiar reasons for the market to go up and down.
Right. So that's interesting. Yeah, so that is the monthly cycle, but that looks like it's a little bit in conflict with the cycle you showed earlier, right? So, or I guess, is that little rise, go back one slide? The seasonal cycle here, right? So
this is the seasonality.
Okay, right. And
so it's December is strong. Then if you start off, if you look at this weekly cycle, you'll note that the market, it bottomed right here in November 30th was a bottom in the cycle and a bottom in the price. Mm-hmm. And then if you go to this one, this is December is right in here. See, there's January. So you have the seasonality pointing up, the weekly and the monthly. What is not pointing up? They're all pointing up.
Got it. Okay. Yeah.
So odds here.
I'm getting sort of captured by the big down move overall from November to, for the next year, right? From November down to September 21. So. Yeah,
well, gold is a very thin market. You find out I lived overseas now for 30 years, and you find out, some royal family sells, and in the Middle East, and suddenly the gold price tanks, and people, the traders will say, well, that's the so-and-so fan. That's how thin the market is. It doesn't take much to move this. But,
yeah, interesting.
Fundamentally, I know some guys, they started a gold fund they're based in Luxembourg, and they went down initially 40%. And I kept telling them, I said, you need some sort of market timing. And they said, well, they're increasing the money supply. I said, yeah, they're increasing it. That's true. But the market is a discounting mechanism. It looks forward. You can't match up the current fundamentals with the price too successfully.
Right. All right. So if I were to tell me if I got this right, okay? So
yes. When
it comes to the stock market, it's super bullish right now through December, although there's some weakness in the week that we're in right now, kind of the 8th to the 15th week in terms of technology stocks, the NASDAQ semiconductor stocks.
Yes.
Are you concerned about the frothy sentiment that we're seeing in the markets right now in terms of the stock market? All these,
there are a number,
put-call ratios way out of whack. Small trader just wildly bullish.
That's true.
But you don't take that into account too much.
No, I do take it into account. And if it's too bullish, it will tend to reduce the percentage of returns when these cycles are up. In other words, the waveform stays the same, but the returns are reduced because there's just too much bullishness. And when the cycle turns down, that's when you get the full effect then. So I think it's much more likely you'll see a correction in January than you'll see it right now. Right now, over the short term, I'm not that concerned. And if you look, of course, one of the best services to monitor this is Sentiment Trader. And if you look at their numbers or the numbers I keep, some like the percentage stocks held by hedge funds and institutions, it's true, they're optimistic, but you need that to keep the market moving up. But in those two series, it's not overly optimistic. And the small options traders, it is true that they are, if you check back, since September, they've been that bullish.
Yeah, exactly.
So the market hasn't come down, has it? So you've got to
No.
wait till the cycle turns down. The cycle doesn't turn down. It does get somewhat weak in January, but in terms of the S&P, it really doesn't look weak. So as I said, the money's got to go somewhere.
But you were talking about maybe April 21 as being a potential turning point.
Looks like a high to me. Yeah, but these you see, when you look at a cycle, you've got to realize, see that little dip there, that could be in terms of magnitude, it could be a huge drop,
Yep.
or it could be a tiny one. Like we've
Yep.
had a tiny one in the last week for the reasons I've outlined.
Yeah.
It depends
Great.
entirely what the technical and market conditions are
Great.
as to how steep the decline will be. Right now, if you remember, we broke out of a rectangle. If you're at the top of the rectangle, you're probably not going to fall back through it. So support is close by underneath. So it's like the old Woody Allen joke in the days when he was funny, when his grandfather lost all his money in the stock market and wanted to kill himself, but he lived in the basement, so he jumped out the window up onto street level. In other words, if the market is not very elevated, it hasn't got far to fall.
Right. And
It's
then
like
for
when
gold, it's overall bearish, but you expect some upness in December.
In gold.
In gold, yes.
Oh, yeah.
Good. All right. Great stuff, Bill.
Okay.
Simple, clear, as always. And Marriott, I forgot, is one stock that you expect to be particularly bullish this week.
Its cycle doesn't top until about the second week of January,
So
but I'm only looking between now and, the last week in December is one of the most bullish periods of the year. And the period December 15th through January 6th has been up, I think it's close to 70% of the time.
And what do you do with that kind of information? What do you personally do with Marriott this week?
Exactly what 1 year ago, there'll be an article in the next issue of the Cycles magazine in Q1 about Ed Dewey's indicator that can only occur in December, January. Last year, that was bullish. And so when I saw that, I loaded up the double long indices, the double long ETFs, the Dow, S&P, which is the SSO, and the NASDAQ, which I think is QLD or QID. I forget which one is up and which one is down.
Mm-hmm.
But I loaded up on those. In other words, when I see something like that, I add leverage, Richard.
Mm-hmm. Okay.
And I'm 100% invested, and I add leverage, which is where I am right now, which is where I was 1 year ago.
All right. And any long-term cycles that are really on your radar?
Well, yeah, real estate. I think we just spoke before the talk.
I spoke with.
I know it's going up right here
Yep.
in New Jersey,
Yep.
and that's one. And the thing that concerns me the most is, this election situation as it clears up. Is if we have a new administration, how radical are they going to be? Because if you start boosting taxes dramatically, you're going to reverse. I mean, if you take away people's incentive to work and earn money, then that profit motive, if that evaporates, then everything will contract. And we're so elevated right now, you could have a massive contraction. So I look at the fundamentals, but the technicals, it's the reverse of that situation of my friends with the gold fund. They start a gold fund, they see the money supply increasing, and the price of gold drops 40%. Now they're doing okay.
Right.
So I try to get them to line up. So at the moment, my cycles work is not reflecting a dramatic switch towards socialist style economics. I'll put it that way.
Fingers crossed. All right, Bill. Well, thank you so much. This was great information. Really appreciate it. And where can people follow your work?
I'm at cyclesresearch.com, where they can email me at bill@cyclesresearch.com.
Outstanding. Bill, thank you so much. Really appreciate it.
You're most welcome.
Bye.
Bye-bye.